Interest rates are going to go a lot higher. The next cycle, I believe, is going to be one of disinflation, deflation, and recession, depression, perhaps engendered by Warsh in his good intentions. It has to happen. I think it's unavoidable. And then by a direct consequence of that recession, if he doesn't let it play out into a steep depression that lasts, I mean, if I had my druthers, it would last short as possible, maybe 2 years, 3 years. You'd wipe all the banks out. You wipe a lot of real estate would come tumbling down. Stocks would come tumbling down. The next recession to try to paper over that triumvirate of bubbles. So there's a good chance the dollar collapses. There's a good chance that long-term sovereign bond yields rise. So there's nothing like we've ever seen this before. And I'll point you to, a plethora of other countries that tried that and didn't work too well for them either. Eventually, they end up in the same place, which is a complete reset of everything. Debt, currencies, what have you.
The global financial system stands on the brink of an unprecedented structural shift, heavily burdened by unsustainable national debt and historical asset bubbles. As central bank interventions reach their absolute limits, the artificial market stability built over recent years faces immediate risk. Michael Pento, a well-known financial analyst, author, and portfolio manager, emphasizes that the upcoming economic cycle will inevitably trigger an unavoidable period of disinflation, severe deflation, and economic recession. A dangerous triumvirate of bubbles across equities, real estate, and credit markets leaves the broader economy deeply exposed. Long-term sovereign bond yields are predicted to rise dramatically, while the purchasing power of the dollar risks a severe collapse. When sudden market triggers force widespread liquidations, paper wealth will evaporate rapidly across highly leveraged portfolios. Preparing for this shift requires securing cash reserves and tactical positions before systemic models signal an aggregate exit. Protecting wealth before major damage occurs remains the ultimate strategy. Now, we present the clips from Michael Pento's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
I mean to say, if I said we've seen times like this before, we've never seen anything like this before. We have never had a triumvirate of bubbles. I mean, I think I coined that phrase, and it's still in existence. Following the COVID outbreak, 2020, we have bankrupted our treasury. We now have an insolvent nation, in my opinion. Assets and liabilities. That's new. And so when you have real estate, equities, and credit all in a massive bubble, and the Treasury's balance sheet has already been severely depleted, decimated, that's what took us out of all the other recessions. Well, what happened? Well, the government spends trillions of dollars by default and proactively, and the Fed monetizes it all, and it worked because the last recession, I think the debt to GDP was like 60%. Now it's 123%. In the 80s, it was 35%. So you're going to put tremendous monetary and fiscal strain the next recession to try to paper over that triumvirate of bubbles. So there's a good chance the dollar collapses. There's a good chance that long-term sovereign bond yields rise. So there's nothing like we've ever seen this before. So I want to get that. I want to be very clear on that. So I have a proprietary financial conditions index. I look at credit spreads. I look at the 5-year break-even spread. I look at commodity prices. I have a 12-point model that's been rigorously back-tested and updated. It used to be 20-point model. I honed it down to 12, trying to get this process as simple as possible, as frictionless as possible. So when I see the first warning signs, I can react. And I'm not doing it yet. I am not taking steps now to protect. And I can't believe I'm saying this. After listening to me, you'd think I'd be in a bunker eating, beans and MREs, but I'm not doing that yet because I need to do what I'm a fiduciary. I have to do what's best for my clients. I'm trying to make money as carefully and as safely as I possibly can, as long as these bubbles exist and persist. But the real upside, I believe, the potential upside is for generating alpha is to be out and short when this bubble breaks. And it will. I can assure you this, we have not repealed the business cycle. Recessions have not been outlawed and eliminated. We will have another one, and the nucleus of the issue is going to be in the credit markets. I don't know if the catalyst is going to be the bursting of the AI investment bubble. I really don't know, and I really don't care. I know what I'm looking at. I know when I have to react, and I will be there before the majority of the damage is done. Let's see what Kevin Warsh does. My guess, my hunch is he's going to try to do something about it next year where he starts to drain the balance sheet down. That's going to cause a repo market crisis, a money market crisis, and then the whole thing unravels. And when you have zero date options that are controlling the market, when you have 3 times levered ETFs and 3 times levered bets on the direction of single equities, the unraveling that's going to take place is going to be so violent and so quick that it'll take me an hour once my model triggers, the aggregate of my model's output says, hey, it's time to get, and it's not going to be binary for me, to be honest with you. It'll be gradual, most likely. It might take me a few days to realize what's going on, but you'll see me, if you're a client, get out, get into cash, get into more T-bills, short the market, and go long the dollar temporarily. Probably not a big position there, but at least some position, because that's what usually happens in a global crisis. The dollar tends to strengthen. And then you'll hopefully generate a lot of alpha, because instead of losing 50, 80%, you might do a lot better than that. A lot better than that. What that means, if the money isn't there, if the money isn't constantly printed, then it's going to mean that interest rates have to go a lot higher to attract this capital, because the money says, the prices have to go lower and the yield has to go higher. Of course, if you print it all and you continue to do so, you run into a huge problem with inflation, and you're not going to be able to float 5% debt on a 50-year bond for SpaceX if inflation is 9%. I don't think it doesn't really make sense, right? So interest rates are going to go a lot higher. The next cycle, I believe, is going to be one of disinflation, deflation, and recession, depression, perhaps engendered by Warsh in his good intentions. It has to happen. I think it's unavoidable. And then by a direct consequence of that recession, if he doesn't let it play out into a steep depression that lasts, if I had my druthers, it would last short as possible, maybe 2 years, 3 years. You'd wipe all the banks out. You wipe a lot of real estate would come tumbling down, stocks would come tumbling down. But then on the other end of that, you'd have a viable, long-lasting, healthy economy, free market-based economy with hard money and a sovereign debt complex that was extremely solvent. But I don't. Who has the stomach for that? Who's going to get up there and say, "Listen, I know this is going to be. You are going to lose your job. You are going to be in a breadline, but this is the only way out of it." The only other way out of it is to hyperinflate, and I'll point you to, a plethora of other countries that tried that and didn't work too well for them either. Eventually, they end up in the same place, which is a complete reset of everything: debt, currencies, what have you.
Annual fiscal deficits currently at $2 trillion are predicted to expand toward $5 or $6 trillion during the next economic downturn as automatic stabilizers kick in. To fund these unprecedented shortfalls, central banks will attempt to monetize trillions of dollars of new debt, swelling balance sheets beyond $12 trillion. This rapid expansion of the monetary base threatens to ignite intractable inflation and weaken currency values. Consequently, interest rates will be forced much higher to attract global capital, driving down asset values while raising yield requirements. With extreme leverage and short-dated options dominating market structure, the eventual unwinding process will unfold with extreme speed and violence. Transitioning to short-term treasury bills and cash reserves will become essential as credit markets fracture. Now, let's get back to the interview.
We had series of depressions, recessions, and bear markets, and you just dealt with them. You live with them because it was part of the cathartic process of clearing out the excess. Excess prices, misallocations of capital, housing bubbles, real estate bubbles, credit bubbles. You have it, but especially after the year 2000, we came up with this new idea. Since we have a complete 100% fiat currency, we could just monetize everything away. And that's where we are right now. So even though they can and have tried that many times in the past, lost decades are coming. And so all you have to do is look at China, Shanghai Exchange since 2007. It's about 40 to 50% down from where it was in 2007. It took Japan 35 years to get back to even in nominal terms. In real terms, it got wiped out. So then I'm sure people will say, well, that's China. That's the Japan. That doesn't really, those statistics don't really work here in the United States of America. Well, let's just go back in the United States. The Great Depression, 20 years following the Great Depression, 20 years, the average annual return for 2 decades was 0.6%. Okay, if you don't like that, it was a once-in-a-lifetime thing. Great Depressions don't happen that often. Let's go to the stagflationary era. That was from 69 to 84. That's 15 years. You know what your average return was in those 15 years? Done again. I know you know because you probably read my piece. 0.5%. That's your average annual return. Of course, it wasn't linear. It wasn't 0.5, 0.5, 0.5. There was big drawdowns there and big spikes, but that was your average return. And even in the modern era of central banking, where we no longer have a dual mandate. So the original mandate of central banking was we are going to loan money to idiosyncratic banks that are in trouble. They're going to loan us their treasuries. We'll give them a discount on their treasuries. They'll pay us back with a penalty. Then it became stable prices and full employment. That wasn't good enough to keep the bubbles afloat. So then it became 2% inflation will redefine stable prices and full employment. Now it's become, we're never going to have a bear market. We're never going to have a recession. And lately it is, we're never going to have a downtick in the stock market and we're never going to have an uptick in the unemployment rate. So even in that modern era, post 2000, say from 2000 to 2012, in those 12 years, the average annual return was minus 0.8%. So we have to come to some realistic grip here from investors. The only reason why we've had these relatively quiescent periods of bull markets is because the Federal Reserve has decided to print trillions and trillions of dollars to keep asset bubbles afloat. But that has now led to 5+ years, I think 5 years and 4 months of inflation being way above target. And there isn't a way on the planet that you can describe 4.2 or 3.5, the last two prints of inflation, as stable prices. It's not stable prices. So the risk is that inflation runs intractable if they keep doing what they're doing. And we'll talk about that in a second, because from what I can see so far, they're keeping doing what they've been doing. Or Kevin Warsh, God willing, is going to try to do something to protect Main Street and maybe injure Wall Street, shrink that darn balance sheet, which he knows full well that's what he needs to do, isn't doing it. But if he does that, we'll engender our own recession/depression, because that's just the nature of asset bubbles. That the enormity of the size of asset bubbles is when we have the next recession, it's going to quickly devolve into a depression. So there was a threefold increase in the amount of deficits following the 2000-2008 debacles in the market, those last two recessions, NASDAQ bubble and the housing bubble. So the deficits right now are $2 trillion. So they should rise to $6 trillion, $5 to $6 trillion. I'm being generous here because of the automatic stabilizers that kick in. There's nothing that has to happen from Congress to create these deficits from increasing. So there's the unemployment insurance, there's SNAP, there's WIC, there's the lack of revenue that comes in as a result of a recession. So automatically happens that these deficits skyrocket. And the question is the Fed going to be the buyer of last resort again? And if they are, which I believe they will, try to monetize trillions and trillions and trillions of dollars of new debt, that's a $5 trillion as an annual deficit. That's 1 year done again. So we already have the Fed's balance sheet close to $7 trillion. We're talking about a $12 trillion balance sheet. What does that do to the dollar? What does that do to the rate of inflation in this country when base money supply grows by $5 trillion in one stinking year? So look at Kevin Warsh. As I said, he used to be like an Ayn Randian Austrian economist, which is the same as Alan Greenspan, right, before he took the helm of the Federal Reserve. So since taking the helm of the Federal Reserve on May 22nd, Kevin Warsh has printed $39 billion. That's $39 billion of high-powered credit or base money supply. That equates to $722 million a day. Now, I'm just befuddled and bewildered as to why a man who knows better, he doesn't need a focus group or a task force or whatever he calls these breakout sessions to figure out what he needs to do to stop inflation, to get it down. He knows, because he says it's a choice. It's the Federal Reserve's choice. He has to stop the inexorable increase of the monetary base. That's done again. It's the liquidity for banks That's what's backing every loan. And that enables banks to expand the broad money supply. It enables banks to gamble on things like, SpaceX. SpaceX is floating 50-year debt for 200 basis points above treasuries, going out 50 stinking years. How much SpaceX are you going to buy a 5% yield, 5.5% yield? Are you placated enough or quiescent in your mind enough that inflation is going to be well below 5% 50 years from now? So you have all of the all of the downside of SpaceX going, bankrupt or inflation going up. But if SpaceX works out to be what it's purported to be, something like we've never seen before in this world, an unbelievable company, and inflation stays around where it is, you just make a couple hundred basis points above inflation. That's not really enough upside for me to take that risk. But when you're printing money, $722 million a day, that's gambling money for the Wall Street banks, and that's what they do. They gamble with it.
Historical precedents demonstrate that papering over structural economic imbalances consistently results in long-term financial stagnation. Drawing direct comparisons to multi-decade market declines in major global economies and historic stagflationary periods, equity markets face extended durations of stagnant or negative real returns. Repeatedly printing trillions of dollars to suppress natural bear markets has severely distorted risk pricing across global credit markets. Once monetary backing reaches its natural limit, an aggressive and complete reset across debt obligations, fiat currencies, and asset valuations becomes inevitable. A sustainable, free market economy cannot emerge without first clearing out misallocated capital, bad debt, and inflated banking assets. Corporate debt issued at low yields will suffer severe repricing as inflation remains stubbornly above official targets. Navigating this dangerous transition demands capital preservation, disciplined risk management, and strategic cash allocations to capture unique value when market liquidations finally bottom out. Generating significant alpha during such downturns depends entirely on avoiding devastating drawdowns while waiting for solvency to return. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.